Good morning and welcome to the Coffee and Cap Rates podcast, your go-to source for New York City's latest commercial real estate insights. This program is brought to you by Ariel Property Advisors.
Hi, everyone. This is Shimon Shkury with Ariel Property Advisors and with Coffee and Cap Rates. And today we're going to talk about the multifamily market, what we've seen in 2025, and maybe what we're going to see in 2026. And I have one of my partners here, Victor Sozio, that's going to tell us a lot about the multifamily market. Vic, how are you?
Good, Shimon. Thank you.
And we also have our Senior Director, Matt Swerdlow, here from our Capital Services Group. How are you, Matt?
Very cold right now, ready to be back though.
That's awesome. That's great. So what we've seen in the multifamily market in 2025 is about the same amount of dollar volume that we've seen in 2024, close to $9 billion. And when we look at the world of multifamily, we divide it to three sections: rent stabilized multifamily, affordable housing multifamily, and free market. And one of the things that we've seen investors do last year is the focus on basis and value. The second thing is the focus on fundamentals. And the third is on policy alignments. And each one of these sectors, rent stabilized, affordable, and free market, behave differently based on these criteria. I want to go back to 2025 and what we're going to see moving forward in a bigger picture type of thing. Vic, what is your impression? We're doing a tremendous amount of deals. You involved in many, many of them. Where do you see the bigger picture based on what you've seen in 2025 and where we're headed in this year in 2026?
So when we look at the numbers in 2025 and we think about them and dive deeper into them and look at it in comparison to 2024, in many ways, it was similar, right? It was about $9 billion of overall multifamily volume. The same areas that were active, like Manhattan and Brooklyn, were active. The majority of the activity was in the free market product type, very similar to 2024. So what is it that we could take away from this? And when we dive deeper into it, you could make an argument that the multifamily market was kind of stagnant in 2025, where a lot of it was much of the same. But towards the end of 2025, that momentum began to pick up. And if you look at the first half compared to the second half, more activity was in the second half. I believe that momentum from the second half will continue into the first half of 2026, and it will be 2 active quarters of volume. We know about the Pinnacle deal that is trading. We have a robust pipeline that is trading in the first half. Many others do. We know of a lot of other deals that are out there and under contract. I think what's the bigger question is what's going to happen in the second half. How will the market digest this new administration at the city level? What will happen in this legislative session at the state level? Will there be any legislative relief for rent stabilized? Will there be more pragmatic relief or policy around affordable housing, which really suffered in 2025 in terms of overall NOIs, right? NEF had a report that 50% plus of the affordable projects were in the red in 2025. So will there be policy to address that? I think this is what we're thinking about going into this new year. So it'll be interesting. Again, the first half I expect to be active. I'm cautiously optimistic there might be good things happening from a policy perspective as it relates to the city and even the state and rent stabilized. I'm hopeful for it. And if that happens, then, activity I think can be really high by the end of the year. So, but it's interesting because as of right now, there's some uncertainty on how it will play out.
Thank you. And what's interesting, Vic, is that the buildings that had the strong fundamentals, the free market buildings, not only traded relatively well, but you've seen many of the owners that wanted to stay in and recapitalize and not let go of the buildings because of the strong rental growth that we've seen in the city. We've seen Steiner taking in Meadows. We've seen Taconic taking in Aris. We've seen JP Morgan buying a building on 43rd and 11th. And so we've seen a lot of those transactions, which accounted to about 70% of all multifamily assets. So the free market world did better than the other two segments. And I'm curious, Matt, back to you on financing. I assume this segment is doing exceptionally well? Question mark?
There are definitely bright spots in lending right now. We have many banks right now that are focusing on free market transactions, majority free market transactions, office transactions, retail transactions, things really that are not regulated, not encumbered, and that can live, breathe, and carve their own path within commercial real estate. So there are not that many blights across all asset classes.
Thank you. Thank you so much. With the rent stabilized multifamily market, which we all know has been challenging because of the regulation that took place in 2019, because of growth of expenses. And in that specific sector, we've seen two types of sellers, those that had to sell and those that had enough. And I'd like Vic to chime in here and tell us what we've seen in rent stabilized housing here in New York City in the past year.
When we look at rent stabilized properties and how they're trading and how the market is viewing them, and we look back at 2025 and look forward here in the beginning of 2026, it continues to be, in a lot of ways, much of the same, in that these properties continue to struggle with revenue growth as it relates to expense growth. And when they go and look to sell or monetize these properties, I don't think that many people are missing that, right? I think people understand that when you have low average rents in the New York City multifamily market today, there is not a tremendous amount of margin, and you really have to be on top of all expenses and account for what's most likely going to be the next few years of not much rent growth and continued expense growth. So how do you account for that in the numbers when you're either purchasing them or financing them? And that's what we've seen, is that, there is a market, because it is New York City and there's always going to be a depth of investor interest. But when it comes to values on these properties, when they're low average rents, they tend to not be priced aggressively, even when the basis is low, and there's not as much depth or competition for those assets. There are opportunistic buyers for properties that have higher average rents, and especially if they're well maintained and low on violation. But even those investors want very high cap rates. So, that market continues to struggle along. And we were really hoping for at some point in the near term future, some legislative relief that can assist that market in making the fundamentals better to transact and to operate.
Vic, thank you so much for this color on rent stabilized. And I wanted to ask Matt Swerdlow specifically about financing. We know valuations are down. We know the NOI erosion that Vic alluded to is a real thing. We see transactions that are trading at, in many cases, 50% lower than what they were before. And so, Matt, what do you see lenders do? And don't sugarcoat it. Tell us as it is.
Thanks for the tee up right there. I think NOI erosion is a really interesting way to think about how a lender looks at lending on a rent stabilized property in 2026. If they start at 75% LTV, what happens to that ratio in 5 years or 7 years? Technically, they might be higher at that point, even with amortization. So what is a lender supposed to do? Right now, what we've been seeing over the last 2 quarters is a trend across banking, across Fannie and Freddie lending, to reel in leverage. What was the 75 is now the 70. If you were 70, you are now 65. And if you were really 65 before, you might not even be in the market anymore. And this trending is happening across different capital sources, across different boroughs in New York City. Rent stabilized lending is not becoming impossible, but it is becoming more difficult. So this is something that we are advising our clients to really get ahead of, because it does not seem like the trend is going to get a little bit better over 2026, especially as noise from the new mayoral administration seems to be increasing attention from lenders.
Thank you. So basically, there are lenders. It's just a lot harder, and it's going to get harder. We can find you a lender, but just brace yourself. It's not going to become easier necessarily for rent stabilized multifamily. Any closing words, Vic and Matt, before we wrap this up? I think, Vic, you had a great overview of 25 and what we can expect for 26, but any closing words?
I think we covered it, Shimon. Thank you for having me today.
Thank you, Vic. And Matt, we're good?
Real estate debt outstanding across the country right now is about $5 trillion, with multifamily up nearly 6% year over year. Some of the real bright spots that we're looking forward to in 2026 are that the agencies have $88 billion of liquidity to lend out in this year each. That's both Fannie and Freddie, so $176 billion total. Additionally, the CMBS market had their best year ever in 2025, which crested both 2007 pre-global financial crisis levels and 2021, which was a banner year for many market participants. And so when you combine those two things, we're looking to have a year where credit and credit availability should not be the thing that holds us all back from having a very transactional year.
Thank you. That's very helpful.